Welcome to this explainer. Today, we're throwing on our financial detective hats to decode some of the most fascinating contradictions I've seen in a while, hidden deep inside the latest numbers for Hydrofarm Holdings Group, trading under the ticker HYFM. Look, if you love solving a good business puzzle, you are absolutely in the right place. We're going to look past the noisy headlines and figure out exactly what is going on with this company.
So let's kick things off with the immediate trigger for our investigation today. Hydrofarm stock recently dropped over 10% in a single trading session. Now, an 11% haircut definitely hurts, but we really need to ask the deeper question here. Is this just your normal, everyday small-cap sell-off, or is the market aggressively pricing in something fundamentally broken within the company's core operations?
And here's what makes this such a compelling mystery. We are staring at a massive contradiction. We're seeing two things that rarely, if ever, go together in the financial world. On one hand, revenue is completely collapsing, but yet at the exact same time, profit margins are improving, expenses are falling, and the net loss is actually getting smaller.
Which brings us to the ultimate question, right? Which metric do you actually believe? Because if revenue is the primary problem, HYFM might just be a dying business slowly fading away. But if margins and cash flow are stabilizing despite that revenue drop, well, we might be looking at the very early stages of a brilliant turnaround. Let's dig into the evidence.
Okay, let's look at the ugly truth first, the sheer loss of scale. In Q2 2026, sales absolutely fell off a cliff, dropping from $39.2 million down to just $23.2 million. That is a massive 40.8% decline in a single quarter. It's the kind of staggering drop-off that would make literally any investor nervous. And honestly, this wasn't just a one-off bad quarter. If you look at the broader timeline, FY 2025 revenue already showed a devastating 29.5% drop compared to the previous year, falling from $190.3 million down to $134.3 million. The top line is shrinking, and it's shrinking incredibly fast.
So when you see sales vanishing into thin air like this, you've got to ask a fundamental business question. How on earth does a company survive such a brutal, rapid loss of its operational scale? Usually, when revenue evaporates like this, fixed costs just completely crush a business. But that isn't exactly what's happening here.
Which brings us to our first major plot twist. Despite the collapsing revenue we just talked about, their Q2 gross margin actually improved, climbing from 7.1% up to 11.3%. Even the adjusted gross margin ticked up slightly from 19.2% to 20%. This proves a really vital lesson. Revenue growth isn't the only way a company can become more efficient. Management is clearly squeezing a lot more out of every single dollar that actually does come through the door.
And this brings us to a critical junction in today's explainer. We need to figure out the ultimate reality behind these margins. Is management genuinely fixing the underlying profitability of the business? Or are they just successfully shrinking a dying business to make it look a little bit healthier on the way down?
To figure that out, we literally have to look at the massive $289.8 million net loss they reported for FY 2025. I mean, when you first look at this number, it seems like an absolute economic disaster. Losing almost $290 million in a single year for a company this size, it sounds completely terrifying.
But if we look under the hood, a staggering $232.2 million of that loss was actually a non-cash impairment charge. In simple terms, they didn't literally burn $232 million in cash. They just adjusted the paper value of their intangible assets, things like brand value or goodwill downward. It's accounting noise making a weak business look dramatically worse than its day-to-day reality.
So once we strip away all that terrifying accounting noise, the real question becomes, what is the actual normalized earning power of Hydrofarm right now? If we completely ignore the paper losses, how is the actual business functioning? Well, to their credit, management is clearly not just sitting on their hands. They're fighting back aggressively on the operational front, successfully slashing their SG&A expenses by almost 38% year over year. That's 37.7% to be exact for Q2 2026. They're absolutely cutting the fat and trying to right-size this ship. But to understand why revenue continues to fall despite all these impressive cost cuts, we really have to zoom out and look at what they actually sell. Hydrofarm supplies the controlled environment agriculture market. We're talking hydroponics equipment, nutrients, lighting, with over 1,800 wholesale accounts. So we have to ask, is the problem specifically with Hydrofarm, or is this entire industry just going through a super painful, prolonged reset? moving away from the accounting side and into the ultimate test of survival, cash flow. In Q2 2026, operating and free cash flow dropped to roughly break even. Now, this is definitely a step back when compared to the positive cash they generated in the prior year, where they saw $1.7 million in operating and $1.4 million in free cash flow.
So you really have to ask yourself, sure, break-even cash flow sounds a whole lot better than losing hundreds of millions, but is break-even actually enough to keep a highly leveraged company afloat? When a business isn't generating surplus cash, the balance sheet essentially becomes a ticking clock.
And this builds into a huge risk factor. With an interest expense of $13.4 million in FY 2025, the company is under severe balance sheet pressure. If they're only breaking even on cash flow, but they have these massive interest payments looming, they might need to raise new capital just to survive. And for existing shareholders, that means facing punishing dilution, where your slice of the pie just gets smaller and smaller.
All right, so let's map out the definitive bull case sequence here. How do we actually win? It goes exactly like this. First, management manages to stabilize the falling revenue. Because they've already cut costs, that stabilized revenue leads to continuing margin improvements. That allows cash flow to turn consistently positive. They use that cash to pay down debt, the pressure falls, and finally, earnings recover. If this exact sequence plays out, today's depressed valuation becomes an absolutely incredible turnaround opportunity.
But if that very first step, that revenue stabilization, never actually happens, we trigger the bear case chain reaction. Revenue keeps falling, which makes those remaining fixed costs much harder to absorb. Margins reverse and get crushed, cash flow deteriorates from break-even straight into negative territory, forcing the company into financing and leaving current investors trapped in a severe dilution cycle.
All of this incredibly contradictory evidence leads us straight to this final scorecard. We're looking at a really fascinating mix of genuinely improving internal cost controls and gross margins, completely weighed down by terrifyingly high balance sheet risks and devastatingly weak revenue. The turnaround potential is absolutely real, but for now, it's completely unproven.
Therefore, the final verdict for our investigation today is a watch high-risk rating. Why? Because while the operational improvements are totally real and management definitely deserves credit for slashing SG&A, the revenue deterioration is just too severe right now to declare this a proven turnaround. A falling stock doesn't automatically make it cheap. Sometimes it's cheap for a very good reason.
So, what's the big takeaway here? To avoid falling into a massive value trap, you must wait for 3 specific pieces of evidence before you even think about committing capital. You need to see revenue finally stabilize. You need to see sustainable, positive free cash flow return. And you need to see continued margin improvement without management having to excessively dilute shares just to keep the lights on. If those 3 things happen, the entire HYFM thesis changes. But listen, HYFM isn't even the strangest stock we're analyzing right now. Next up in our Explainer series is CISS. This is a company that suffered an almost identical massive single-session drop, but it hides a completely different, much harder to explain growth story that you absolutely won't want to miss. I mean, how can a growth story be this complicated? Join me in the next Explainer to find out.